Hello and welcome to this AssetTV Emerging Markets Masterclass. We'll cover multi-year trends to focus on, investing in different countries, what makes EM markets attractive given the broader macroeconomic risks, and much more. Joining us now, we have Andrei Glukov, Portfolio Manager for the TCW Emerging Markets Equities Group, and Rand Wrighton, Senior Managing Director, Equity Portfolio Manager at Barrow Hanley. Well, everyone, thank you so much for joining us.
Great to be Thank you for hosting us. Cheers.
Well, starting with China, Andrei, it's 30% of the index and well over 50% of the equity universe, and it strongly impacts every other EM and DM market due to strong economic linkages. We've seen the biggest negative deviation in policy path versus expectations in that they completely failed to provide expected economic support. Where does China go from here?
It's a good question. I think that the challenges here that the country is facing are twofold. One is to start with the obvious is the COVID zero policy. Right? It both weighs on the economy and it impairs any stimulus transmission that the government is trying to make while pursuing this policy. There's certainly testing, reopening with Hong Kong and Macau now. It remains to be seen how that goes, but the policy is very disruptive, even if it's moving into the right direction. More conceptually, though, the government clearly decided that it needs to transition to a new growth model. Right? So China is reaching the limits of pouring concrete and generating growth that way, and it has passed the lowest point. The government understands the dangers of the premature deindustrialization and the loss of productivity that comes with it. And therefore, it is there are two things that it's trying to solve. One, as a combination of sort of the demographic challenges as well as the external challenges with the U.S. tension, they are pursuing the common prosperity and efforts to reduce any external vulnerability. Right, and the second challenge that they need to solve for is the current real estate challenge, which was a big driver of the economy up until now. They have decided that the sector is not supportive of the future direction they want to take the economy into, and they want to significantly decrease the importance of the sector in the economy without losing the price anchor. So, what are sort of some of the implications? Changing the model of growth is inherently very hard, and a lot of countries have had significant economic volatility trying to do that, right? So China, as a result of this, is probably shifting to a structurally lower rate of growth. May not be sort of the 2.5%, 3.5% they're having now, but it's certainly, let's call it 3 to 5% going forward. And it's likely going to have to exhibit more growth volatility during this transition. They are also centralizing their decision making, increasing their reliance on central government and the SOEs, which may optimize short-term resource allocation, but can certainly lead to greater longer-term errors and harder to correct errors. So I tend to think that from here in China, the opportunities are shorter term, the typical sugar rush reopening trade that we've seen in all other markets, and eventually it will happen, and one can try to time that. Or more interestingly, you can go for more structural themes where you can take a longer view, which are the advanced manufacturing, the green tech areas, which have the government support and sort of rely on innovation, and some of the more traditional areas of EM investing, like formalization of retail, like premium consumption, like emergence of the domestic brands. So that's kind of how I think about it.
Can you talk about China specifically, Rand? Some investors are now saying that they believe China is not investable. Do you disagree with that, or where do you stand?
Yeah, sure. And I think Andrei makes a lot of great points. We certainly think China's investable. I think when you look back over the last, 5-7 years, when we had a very strong run in parts of the sort of the Chinese investable market, particularly the technology and the consumer discretionary areas, I think that you had a situation which happens in a lot of bull markets where risk gets underpriced And I think that too many investors were too quick to draw equivalency between some of the tech champions in China versus, relative to the tech champions in, say, the U.S., where you have, some fundamental differences with regard to rule of law, resistance to interference from the government. China has been and always will be, at least for the investable future, in emerging markets where those things have to be taken into consideration and factored into your investment view. And I think when you look over the last few years, you had sort of a toxic intersection between high valuations and an unexpected turn in policy with a lot of investors. And so, when you step back and think about what that has meant, the government has decided to shift a little bit and to focus more on areas that they've traditionally been supportive of. If you think about infrastructure, you think about aerospace, healthcare, technology, semiconductors, and away from areas like video game technology or excessive consumerism or things that might inject more leverage into their system like fintech. And so, while those rules and priorities have changed, that's nothing new to an emerging market. If you look at all the other countries across emerging markets, the rules of business frequently change, and that doesn't make the market any less investable. It just highlights the importance of having your capital with a manager that's staying close to those changes and factoring in those elements to their investment decisions. And so, as we sit here today, we actually still think the future looks quite bright for China. You have to think about what's important to the government, where they're going to enable growth over the next 3 to 5 years. Where are the values in the economy, and where do you think your investors can benefit the most? And from that perspective, you've had a lot of pressure applied across infrastructure, healthcare. You've obviously had a lot of sentiment shift as some investors that were invested in the wrong area got hurt, and as people normalize the new policy environment alongside the pandemic overhangs that Andre touched on. I think when you look out over the next 18 to 24 months, they're starting to loosen up a little. They're starting to float balloons around normalization of travel, reopening Hong Kong, Macau. And so, our view would be that, the second derivative on things in China, both in terms of, growth, in terms of opening up, normalization post-pandemic, are positive. And right now, you're not paying a lot when you look at the assets there to participate in those. But it'll remain important to account for the risks that center around, the policy imperatives for the government. So we actually think it's as investable as ever. We think that it's also as important as ever that you take into account the full mosaic of both individual industry and company fundamentals, as well as policy objectives of the government.
I'm turning to Taiwan, Andre. How concerned are you about escalating tensions with China?
I think it's fair to say that the tail risks have gone up. I think that given where China is in its economic cycle right now, it is still unlikely to kind of lead to any kind of tail events on a couple of years view. But I think we do need to be mindful that sort of the policy path of both U.S. and China can create some additional tail risks. Let's say 5 to 10 years out.
Rand, I would love to hear your perspective on Taiwan as well.
Sure. Yeah. No, I would agree with Andre's point around tail risk, but to be perfectly candid, I think it's a very remote tail risk in terms of some kind of a confrontation. For a number of reasons. The most important being that what China wants from Taiwan would be destroyed effectively if they were to use military force to gain it. They want the technology hub, they want the people, they want what they've been able to build as far as a differentiated technology landscape, in addition to bringing them back in the fold. So I think when you look at how the Chinese have traditionally acted, they've been very conservative. They've moved fairly slow. They're very thoughtful around their moves, and so I guess our interpretation is that what we've seen recently is more in line with the steady sort of ratcheting up of pressure to extract more concessions to try to move the ball a little bit closer towards, reintegration. I also think that given what's happened with Russia and the Ukraine and the response that they've observed for the rest of the world, I think that has now firmly come into the calculus as well. And you really can't forget about the role that Japan has to play, the long history that you have between Japan and China, and to engage Taiwan in an aggressive sort of a military type of fashion, I think would set into motion some very big sort of geopolitical moves that I don't think they have an interest in doing. And so, as we talk about around, our firm, we think it's less likely that the Taiwan situation, even in the long term, will be resolved with force, but perhaps more resolved with money and co-opting. So we think that's a very, very remote tail risk and somewhat of a red herring as we sit here today.
And macro is in all the wrong zip codes these days, Andre. Inflation, U.S. rates, global recession, commodity shock, flight to safety flows, and strong dollar. Generally, this is when EM has accidents. And if the UK is having one, are we also due for one in emerging markets?
So I sympathize with the fact that the environment is challenging particularly for ex-US assets. But what I would say is there's a couple of things that for EM that I would call out. If we think about what are the key challenges across the developed markets, they can be kind of grouped together in output gaps, housing, and labor issues, right, which are leading to the situation we are in now. And across the developed markets, all three are broadly trend negative, right? And in EM, however, they are all broadly positive except for housing, specifically in China and Korea. We talked a little bit about China. I think it is important to recognize that EM central banks have been ahead of DM central banks in managing the external shock. They have been proactive in increasing the rates ahead of the inflationary spike, and therefore you're already starting to see situations like Brazil where growth is doing quite well and inflation is coming down because they were ahead of the curve. In addition to that, one benefits that EM growth models do have is the EM countries are quite accustomed to growing in the face of elevated inflation, which is not something that we've had in emerging markets. The other thing about EM that I would sort of call out in this context is that the commodity price shock that is being experienced by the developed markets, particularly Europe, is substantially less than that's being experienced by EM, especially Asia EM, which is a big part of the market cap. Asia EM has stayed at sort of rather arm's length from the Russia-Ukraine conflict, and therefore is continuing to get an ongoing flow of highly discounted oil, and that therefore that reduces the energy pressure that they're experiencing. And I guess the last point that I would make relative to the traditional times when EM has had issues is that the problem children, the people dependent on a significant amount of external capital, your Turkeys, your Argentinas, are insignificant in the context of equity markets and have largely been kind of exited by international capital. And therefore, even if they were to have issues, the transmission mechanism is not really there. The risk of spillover to broader EM is really not there.
And Rihanna, I want to ask you a little bit more about currency risk and the trend against globalization in just a second. But broadly speaking, anything that you would like to add in terms of the macroeconomic environment in emerging markets?
Sure. Yeah. Look, I do think it's a very interesting and opportune time to be looking at allocations to emerging markets. I think, firstly, when you think about the last few years, the pandemic normalization really, was led the U.S., Europe kind of lagged by 6 to 8 months, but Asia and a lot of emerging markets really never got going as far as normalizing post the pandemic. I think too that they did not have the same ability to ramp up, fiscal stimulus measures, which provided less of a buffer, but now I think is less of a headwind terms of that coming down. And so, when you look at it from an investment perspective now, you've had a lot of things go badly and create a lot of headwinds and push down valuations. When you think about the dollar really surging, which puts a lot of pressure on the emerging markets, obviously it creates a headwind to Western investors that are in the asset class that can be measured in dollars. But more importantly, it squeezes the financial system. The simultaneous higher commodity prices with the strong dollar also not that common occurrence, but pressures EM. And so you've seen sentiment, you've seen valuation really come down, and you also, I would argue, in many instances of the investment opportunities, you see profitability levels depressed alongside fairly constructive balance sheets and a lot of the investment opportunities with attractive dividend yields that will actually be even more attractive if you see a currency normalization. So when you think about that relative to other asset classes you could look at, whether it's U.S. or European equities, we think it's very attractive, and all those macro risks, the headwinds, we think have been mostly discounted into the opportunity set. So we think over the next 18 to 24 months, it's a pretty appealing place to look for opportunity.
So I guess to Red's point, if I can just amplify, if we think about the valuation point in the markets where we are right now, U.S. assets have certainly enjoyed pretty significant run since the global financial crisis, and even after most recent correction, U.S. as a market, looking at the variety of valuation metrics, is roughly half a standard deviation expensive versus its long-term averages. Right, the world is probably roughly in line with its long-term averages, whereas the emerging markets are rapidly approaching one standard deviation cheap. Right, so if you think about kind of valuation is not predictable for returns on shorter horizons, but it's certainly predictable for medium to long-term returns. And Brian's absolutely right that there is a strong opportunity here. And then thinking about the dividends, right, looking at the trailing dividend yield right now of this level, we are at the bottom decile of historical dividend yield levels. Traditionally, emerging market on a 3 and 5 year view offer quite attractive, positive absolute dollar return. And on top of that, we've obviously under-indexed relative to kind of trend line growth returns in EM, much more so than we have in a variety of developed markets.
Yep. No, that's a great point. I mean, I think we've been in a market over the last 5 to 7 years where dividends have not been as in vogue, but over the long term, if you look at emerging markets, the impact of the compounding of cash dividends accounts for almost half of your total shareholder return. And where we are right now, there are a lot of sort of mid-single digit dividend yields to be had that are backed up by fairly strong balance sheets and even levels of depressed profitability that we think have pretty low risk pathways to improve on a normalization. So yeah, that's a great point, Andre.
Certainly. And Rand, how do you think about the currency risk that a strong dollar presents to EM? Are there any opportunities being created by the currency stress?
Yeah, well, listen, I think we are at a point of max pain. I mean, maybe we're not at the absolute climax, but I think historically, when you look at, say, with the Federal Reserve, when they're in a very strong hiking cycle, I think we're going to get to where they're going relatively quickly, within 6 to 8 months. And I think you're seeing the currency markets adjust to that, at which point I think it's reasonable to see some relief and potentially a sort of a more of a mean reversion. If that occurs or even partially occurs, the lift to which you get on those cash dividends, particularly in the countries where you have had the weaker currencies, that'll actually turbocharge that return. You've got to get through the period of stress, but as Andre pointed out, the central banks and emerging markets have done a pretty good job in front of this, and you've seen the currencies hold up far better than they have in other similar type crises. And in fact, it seems like for this cycle, more of the pressure is really being applied in Europe and the UK on their currencies. And so, within that context, while this is a headwind, I think we're probably closer to the end than people realize, at which point the relief that they get, if you're looking out 18 to 24 months, could be a really strong tailwind.
Speaking of stress, not necessarily within the context of FX, but broadly speaking, Andre, if you think about prior periods of stress in emerging markets, how is this one different?
Well, I guess, you have two major points to consider. As we talked about in the beginning, China is no longer an anchor necessarily, right? So if in global financial crisis, they have been very aggressive with the stimulus, stabilizing both the region and really the broader global economic growth, they are unlikely to be doing that this time around. The second variable, I guess I would offer that is more challenging is if you think about the taper tantrum of 2013, Fed sort of rediscovered its international mandate and adjusted its policy, which allowed for a faster recovery in EM assets. I think given what's going on in inflation, it's safe to say Fed is not about to turn international. So that's certainly also a speed bump that one needs to think about. So I think from a standpoint of aggressively taking risk in EM, one needs to take a view on peak Fed or trough growth, right? EM is fundamentally a growth-sensitive asset class. So once your currency pressure subsides, once you can take a better view of global growth, these are the times you really want to have over-indexing to EM assets.
And Rand, what impact do you think that the trend against globalization will have on emerging markets?
Yeah, that's an interesting question. I mean, it's obviously been underway and is real as the world moves more towards kind of a bipolar framework where the U.S. on one side, China on the other side. We think that's gonna increase the relative importance of China. We think that it's actually gonna help develop some industries that are focused more on intra-Asia business. We also think that it'll sort of turbocharge some of the development of other true international companies out of China. If you look at what China's done, while it's been remarkable to see the domestic growth, they still fall a little bit short of creating true sort of international business champions. We think this might increase the emphasis to do that. On the other side, we think that the trend towards reshoring is, people have talked about it for a long time. We think it's actually starting to really accelerate, and that's going to benefit, places like Mexico, where you've already seen some of that, but we think you could see, some escalation of that. We also think there be some knock-on effects in different parts of Asia as well. So, I'd say it'll be different. I don't know that it'll be the headwind that some fear it will be. I think there'll be other opportunities that come about, particularly inside of emerging markets, that counter the opportunities that are lost, perhaps from some of the developed markets' point of view.
Let's talk Russia for a moment, Andre. There's obviously a possibility of further commodity shocks, and to the extent that Europe gets squeezed more, what are additional risks for emerging markets from here?
So I guess with the caveat that I don't necessarily have any differentiated commentary on the conflict itself. If you think about the sort of the spillover effect to the rest of the world, I guess as far as the direct effect, again, EM is relatively better than developed markets. Why? Because the importing developed markets like Europe, the commodity importers are having quite obvious challenges with the energy shock. The commodity exporting developed markets like US, Canada, Australia are dealing with the inflation rate and rate dynamic that is pressuring the assets. That said, the EM commodity importers, as we talked about, don't have nearly as much pressure because they're getting a subsidized energy, and EM commodity exporters have taken the time and adjusted, the central bank policy and therefore terms of trade, and have been ahead of the curve. So what's happening from here? I think from here we can segment it into a few different buckets. As far as oil is concerned, the flows of oil out of Russia have been unchanged relative to pre-war level. Particularly if we do believe that China reopens next year, which I think is a fairly reasonable assumption that at some point next year they will reopen, that will create significant additional demand for oil and ensure ongoing kind of supply from Russia. So I'm not convinced that there is a spillover effect to EM on the energy front. I think that things like gas have negative implications for Eastern European emerging markets, but they are fairly limited in the context of an aggregate equity impact for EM equity. I think that what one should think about in that context is it will accelerate energy transition, it'll accelerate investments in renewable energy, and those really require significant investments out of North Asia, China, and Korea, and those industries will really benefit. I think the important dimension to watch would be food. The spike in ag prices has abated, but I would continue to be monitoring that dynamic. It is important for some of the smaller emerging markets, particularly less developed ones. And in long-term view, I would really think about this. This might actually end up being quite beneficial for countries like Poland and Turkey, which have risen in the geopolitical importance and therefore may have substantially more fiscal support from the developed markets, which can accelerate their development.
I might add on to Andrei's comments. I agree with the points he just made. I would come back though to the concept of tail risk, which we touched on when we were discussing Taiwan. I do think when you look at the situation in Ukraine, the spectacular failure of the Russian military versus their own expectations versus the world's expectations has created a very precarious situation where you have, a leader that's gone all in, that there's really no way to back up from this. Yet the military under his, control appears to be collapsing. And when you think about what that could mean, they just recalled up or calling up a bunch of reserves, but that there doesn't have to be a linear relationship between, hey, just throwing more people at it and that buys you more time or success. In military operations, that's not always the case. And so there is the risk that you see an even faster accelerated collapse of the conventional Russian military, which starts to bring back the focus on some of the reckless threats they've made around tactical nuclear weapons. And while I don't think this is likely, I think it's a tail risk that's growing and it's really hard to handicap. And so, to Andrei's last point on food, I think that's the bigger commodity risk. I mean, oil has always found its way out of war-torn territories. Most commodities do. But and food will too, barring some kind of an accident. But I think if something really comes off the rails, unexpectedly bad happens in Ukraine, most people don't realize Ukraine is really the breadbasket of Europe. And if you have some kind of an accident, something where you get really ugly in there, that could disrupt and be meaningful shock to food supply and prices. I think when you step back, setting that aside longer term, I do think it creates a headwind to Russia's oil production when you get past sort of the near term, because if you look at the decline curves where they need to grow, the emphasis is going to shift to tertiary recovery technology as it relates to their oil resources. And that's an area where they were really going to need Western technology and help. And I think it's fair to say that won't be there under the current construct. So it's a scary situation in our judgment, where the tail risk has grown a lot, and the tail is pretty dangerous. And so we're watching it closely, but I think if you're looking out at the next 3-4 months, I think those elements that Andrei pointed about, the commodities getting out and not being a serious risk, but past that, I think a lot of things are possible, and there's a constant scrutiny from the investment community.
Now, given all of these risks that we've talked about, why are EM markets attractive currently, given the broader macroeconomic risks, Rand?
Well, look, I think it's a combination of, really cheap valuation, some great assets that produce a lot of cash flow, cash dividends that we also think are under earning, that you'll see an acceleration of, earnings and cash flow, as well as, multiple valuation appreciation as some of this pressure lifts. It's a very out of favor asset class. You've seen a lot of flows come out of emerging markets. We don't think a lot of investors are there yet where they're pushing a lot of money in. So it's a combination of an out of favor asset class that's seen a lot of outflows, cheap valuation, a lot of companies that we think are under earning yet are paying you pretty attractive, cash flow to sit and wait, as well as the kiss that you can ultimately get from a recovery in some of the currencies. So as Warren Buffett famously said, be fearful when others are greedy and greedy when others are fearful. I think that applies in some measure to where emerging markets are today. I think for investors with a longer term horizon, looking at starting to allocate some more to EM, this is a good time to start to do that.
And perhaps a lot of those risks have already been priced in.
We think so.
Now, with politics back in the news, Andre, there are a number of elections over the course of 2022 and 2023 in EM countries. What are the risks and opportunities here?
So I think that the overarching dynamic that we've seen in elections is sort of a COVID revenge vote. Let's vote out the gal who made us sick during the pandemic, right? And we've seen this in Korea, we've seen this in effectively Italy, we've seen this in Colombia and Chile. So I think that the near term narrative will follow that pattern. Looking at EM elections coming up, Brazil is next up. I think everybody, or the market generally assumes that the opposition candidate will win. The market generally would like that event. Beyond that, once sort of the ruler settles in, it will come down to how much fiscal discipline he will really have. It's important to recognize he's inheriting the country in a very good spot with good growth and improving inflationary dynamic. Then you have effectively power transition in China, which remains to be seen, and I think it will be important to watch the composition of the Politburo, how many sort of reformers versus conservatives are there. And looking at next year, I would probably call out Turkey. Is happening next year. It's really in my mind an option structure. If the opposition takes it, that will be very positive for the market for a country that has been largely abandoned by EM and international investors. Then you have Argentina, which will be interesting in that the entire LATAM is moving left in this COVID revenge vote, and there you have a left that will likely going to move to the center, which generally is market friendly, but the center will inherit economy in very difficult shape. And so then once you go out of next year, you have some really important elections in early 2024 with India, Indonesia, South Africa, and Mexico. There, I think, it's too early to comment, but the COVID revenge dynamic is probably going to subside, and it will be really dependent on how the incumbent handles the recessionary concerns that we are going through now.
Rin, would you like to weigh in as well?
Well, listen, I think Andre did a good job covering, kind of what's coming up in EM elections. The only thing I might add is that, you do have to factor in what's going on in Europe as well. And there's clearly a very difficult 6 months ahead, and it's not entirely clear if they have to go into energy rationing, and you have a very severe sort of economic shock on the back of that. It's not entirely clear what that means politically, and that to the extent that causes a lot of disruption, greater economic stress, that's an important destination for exports, and that could pressure all markets, but certainly Asia, EM as well. So that also bears watching.
Why would you say that value is the best place to be positioned in emerging markets in this market environment and over the long term, Rand?
Well, look, I think we've just come through almost a 10-year growth cycle. And I think when you look at the setup for the next couple of years, you've got a lot of tailwinds to areas and sectors that have traditionally been stalwarts of value products, value investors. If you think about the rise in interest rates and the flow through to financials, and particularly banks in terms of net interest margins, we see a lot of opportunity there. for core levels of profitability and earnings growth to pick up. We also see opportunity within the commodity spectrum, which had a fairly negative run. If you think about the energy value chain, that's become a lot more constructive. I think even if you see, a rapid energy transition, you're still going to need at least one more energy cycle as you're going to get tight on the back of normalization. And to the earlier comments we made around the yield opportunities, they're certainly there. And in general, value assets, I think, are more severely discounted when you look at those entry points that you're being presented with right now in emerging markets. So, look, we think it's a very good entry point into value and the EM value in particular. And we think that when you look at the underpinnings of value cycles historically and the similarities of what we're looking now over the next couple of years, that it bolsters that case pretty substantially.
I guess I have a lot of sympathy to that point of view. I would probably, at a high level, respectfully disagree. Particularly in Asia, specifically, which is a lot of the market cap in growth has been probably the best returning long-term factor. We're talking our own book. We tend to be growth-oriented investors. So, given where the market level evaluations is, given where all the assets are, I actually think that there is ample opportunity on both sides of this.
And ESG is also a rising topic of conversation, Andre. How are you thinking about opportunities and constraints within environmental, social governance factors?
So we think the biggest impact is in energy transition. So specifically the E portion of ESG. It's high priority, it's high impact, it's high potential in EM. We also can't solve this problem without an EM. And the both basically emerging markets, particularly China, Korea, Taiwan, are very good in producing the critical elements that are required for the world to solve that problem. And while those industries are very capital intensive and therefore need continued access to public markets, so the capital allocated there has sort of a societal purpose. I think that right now, renewables are very low single-digit percentage of the global energy balance. But we just reached the point where solar is reaching cost parity with the grid. The spike in global energy prices helps. I think the adoption curves from here should not be underestimated, and you will see a lot of sort of opportunities of technological evolution arise in EM, which present very attractive investment returns. Looking at broader ESG, governance is very important. I think it's fair to say EM has fewer institutional guardrails, and therefore any EM investor will tell you that they're spending a lot of time on management or consistency of execution accounting, just because there's sort of high risk associated with it. And then the last point I would make when talking about ESG, more generic ESG, the direction of travel is more important than the current state. I would be careful about necessarily putting a straitjacket or DM ESG standards on every EM company. I think we're not there yet from kind of the market maturity, talent availability, and some other institutional constraints. But as long as the companies are gravitating in the direction you want them to gravitate, and the engagement is yielding some results, I think that this is kind of higher priority at this point.
Yeah, I'd add to what Andre said. I think his last point is a really critical one. The direction of travel, and I think when you look at the progress that's being made in EM, coming admittedly from a significantly sort of lower starting point versus the developed markets, I've been very encouraged, and we're pretty active engaging with management teams. I think most EM companies are anxious and excited to learn about best practices. They certainly want to move forward and they want to improve on all fronts. And so, when we think about ESG and engagement. We think about, as the company measuring and disclosing, the key information around, carbon footprint, diversity, inclusion, et cetera. We think about, do they have targets and goals? Do they have enforcement mechanisms tied to KPIs or other mechanisms? And are they doing a good job communicating that both to the third party raters and to investors? And I think on all those fronts, frankly, that they're making significant progress, and they benefit just as China benefited, for example, from technology transfer and know-how and business recipes coming from the West. I really think emerging markets are benefiting from that transfer from the developed markets. And I think certainly we're not alone. I think most developed market investors are engaging with them and they're responding. And so I think you're going to see progress at a rate that is much faster than what people expect within EM. And I think that's a real positive thing.
Certainly. And are there any specific areas of emerging markets that you see doing well over the next 1 to 3 years, Rand?
Yeah, I mean, look, I think, and I touched on a few of them, within financials, we're fairly constructive as we think that, directionally, particularly in the banks, you've got sort of the double benefit of, economic normalization on the back of pandemic lockdowns, et cetera, as well as you have a steady sort of tailwind to net interest margins while credit has remained fairly manageable. We also think real estate is an attractive area to be looking at right now. When you look at the cap rates that are available to invest in, we think those are pretty appealing. And actually, we think consumer staples is an area that has not traditionally been where you saw a lot of great values. The temporary move that we've seen in inflation has really pressured the margins, which in fact is followed through pressuring the stocks and valuations. And these are very good long-term businesses. We have a lot of confidence in that most of the companies in that area will be able to pass through ultimately, the inflation, and that you'll see a normalization of returns there. So we think that, those areas are pretty constructive. And we think particularly if you have an 18 to 24 month time horizon, it's a good time to be looking in those areas.
I guess, yeah, thank you. I guess it is important to take, when you have a lot of market volatility, right? What one tends to need to do is extend the time horizon and take a longer view of where does one have conviction. So we are a bit of a growth investors. So from our standpoint, there are generally maybe 4 buckets of opportunities that are emerging across EM. So one is energy transition that I've talked about, right? Climate remains a priority. We are seeing significant improvement in adoption of electric vehicles. If you look at China, they're growing 100% year on year. They are 25% of marginal sales, but still well below 10% of out of park. And some of the similar trends are playing out with a bit of a lag across developed markets, and the technologies are coming from EM. Equally, in renewables, polysilicon capacity is growing 55% this year, 60% next year, but solar is still 3% of Chinese energy mix and 4% of the global energy mix. And we are on the ground floor of the growth of this. So energy transition is one. Second area that I'd focus on, you talked about deglobalization. The US-China decoupling and deglobalization presents significant opportunities across EM, be it in semis, be it in healthcare, be it in some of the EV supply chains. You will see emergence of domestic champions and explicit preference in a number of our countries for domestic champions. So that's something I think about. EM innovation and sort of EM tech champions. Tech is on sale globally. EM is no exception. So I think we are going to get to a level of valuations where some of the kind of global leading technology companies present opportunities. And lastly, as Ron mentioned, I would look at EM consumption. So whether it's a formalization of certain areas of retail, whether it's going premiumization of consumption, whether it's increased consumption of healthcare as GDP per capita rises, that continues to be a quite attractive investment area.
On the flip side of things, what's your largest underweight at EM in terms of both country and sector? And can you share any thoughts about why you have this positioning? Rand, do you want to kick us off? And then Andre, if you'd like to weigh in, please do as well.
Sure. Yeah. So when you think about countries, where we have significant underweight is India, which, frankly, there's a good long-term story in India, and there are a lot of good assets there. We just think when you look at the valuations that you're being asked to pay right now in the market, that they're nearly as expensive as they've been relative to the rest of the opportunity set emerging markets, in the last 15 years or so. We're also fairly underweight in Taiwan, and that ties in on a sector basis where we're less constructive, which is in information technology. We think the valuations there have not corrected enough. We think there's also some significant headwinds over the next 6-8 months that you have to get through with regard to inventories and some of the weakness that you're seeing in the technology chain. And I'd say the last region that we're underweight is in the Middle East, where we have had some exposure there, but given the run that you've had and I think in part the run that you've seen oil and the knock-on effects, we don't think it's as attractively valued as it once was. So I'd say in terms of the other sectors, really it's in comm services is the other area. But when you think about it holistically, it's most of the companies that are tied into information technology. So really across technology is our really big underweight, where we're using that underweight to fuel a lot of exposure in other areas. And that certainly I think is how we're positioned now, but we're continuing to watch as you see all this pressure applied, and we'll see what the next 6-8 months brings.
I guess we're a little bit more thematic, and therefore a little bit more agnostic on country sector. But if just to echo, we're probably a little bit we're equally somewhat cautious on India. The market has not really corrected, unlike a lot of other places we invest in. We're equally cautious EMEA, driven by the Middle East weight, and then in the context of more commodity tech, we are underweight Korea, where memory is going through a somewhat difficult time and still needs to adjust. We're probably in aggregate somewhat less negative information technology, although that's driven by some very specific non-commodity technology positions.
Moving forward and looking at the long view here, Andre, what are the multi-year trends to focus on?
Well, so again, I'd call out energy transition. I'd call out China-US decoupling. I'd call out EM consumption as kind of areas I'd really be positioning for.
How about you, Rand?
Yeah, look, I agree with those points. I think I would add to that there's still a fair amount of urbanization that can happen, as well as there's a lot of under-penetration in emerging markets, whether it's in luxury goods, financial services, credit. So I think that the promise and what people have always been excited about emerging markets is still very much there. There's a big opportunity to sort of incrementally close the gap with more developed markets, and I think whether that's in consumption or that's in technology, it's all there. And I think that while we've gone through a tough period in emerging markets, those longer term exciting drivers are still very much in place.
If I can just throw in a Hail Mary on this question on a really long-term view, if you look at the composition of the EM universe relative to like an S&P 500, it is actually quite similar with one giant exception, and that is healthcare is roughly 15% of the US indices and 3-4% of them. I would venture to say that if we speak in 10 years, healthcare is not going to be 2-3%. It's going to be much larger. So from a truly long-term view, that's sort of another area where I think EM will grow up. We'll see more innovation in EM. We'll see more consumption.
Well, as we wrap up this panel discussion, and before I let you go, I'd love to take a few minutes to go around the room and let you share your final thoughts with our viewers. Rand, would you like to kick us off here? Sure.
Listen, I think that it's easy to get caught up in the current events and look at a lot of the pressures and the headwinds, but I think savvy investors tend to think about the longer term, looking out 12, 18, 24 months. And I think I would just encourage people to think about it within that point of view. And with that in mind, I think it's an exciting time, and there are lots of great opportunities for investors that want to put some money to work for the long term.
I think it's a great summary. I'd just add, obviously, selfishly, we would always say that EM should be an anchor tenant in any portfolio allocation. But even putting that aside, given the prevailing level of valuations, both on a kind of relative to itself and relative to some of the developed markets, I would, at a minimum, start looking at opportunities that are arising given the adjustment we've seen.
Well, Rand, Andre, thank you both so much for joining us.
Thank you, Jenna.
Jenna, it's a pleasure. Thank you.
And thank you to everyone watching this Emerging Markets Masterclass. Once again, I was joined by Andre Glukov, Portfolio Manager for the TCW Emerging Markets Equities Group, and Rand Wrighton, Senior Managing Director, Equity Portfolio Manager Analyst at Barrow Hanley. And I'm Jenna Dagenhart with AssetTV.